Cool. So this is the last panel for lunch. I'm glad to see everyone's still excited, still paying attention. I'll start to my left and just have everybody introduce themselves briefly before we get started talking about this topic that I think about a lot, right? Which is, how do we get to replace basically traditional finance rails by DeFi rails and onboard the world's assets? So I'll start off with Ryan.
Hi, everyone. I'm Ryan. I'm the founder of Plaza Finance. Plaza is a platform for composable bonds and leverage.
Hey, I'm Max from Symmio. We are an OTC derivatives on-chain protocol, and we're offering all Binance futures derivatives on-chain self-custodial. So if Binance or Bybit goes down, something happened recently, you are fully protected by trading with us.
Everybody, I'm also on. You guys switch on.
Hey everybody, Is it better now? Hey everyone, I'm Altan, one of the founders of Nuffle. Nuffle is a stake from anywhere solution, which allows you to stake any tokens from L2s and L1s to EigenLayer, but now we're extending that protocol to any DeFi, so that's the exciting part.
Hey guys, I'm Charco from Camp Network. Camp is an L1 focused on building consumer apps for user identity. And I'm head of DeFi, so mostly focused on DeFi.
Cool. So I'll start out with my thesis for DeFi and crypto generally, and throw it back to you guys and see where we're at in terms of getting to that goal. So, I started my career in e-commerce, and I like to think as the way the world evolved from before e-commerce to e-commerce as like we used to have commerce, we still do, right? But that commerce existed on like other rails, right? It was like fax machines and letters and phone calls, like kind of this archaic infrastructure. And then the internet came around and we put all that commerce online. Still the same commerce, still the same products and services. They just have better rails. And also those rails enabled new types of products and services to emerge. So things like Uber and Deliveroo and like the internet economy couldn't have existed without these rails. Now with crypto, I think it's sort of a similar thing, right? We have assets. They have like tens of trillions, hundreds of trillions of dollars worth of assets that exist on traditional finance rails. And people are thinking about how do we bring TradFi onto crypto? I think that's looking at the wrong target. We need to bring assets onto crypto. But right now there's only about 1% of the world's or US dollar M2 existed stablecoins. RWAs is like $10 billion. How do we get from that to like massive scale in order to bring the world's assets onto blockchains?
Personally, I think it's a user experience question. I think you have to make it less friction to use these apps, these digital asset apps. Currently, Venmo is the easiest way to pay any of my American-based friends. But the use case that got me into crypto in the first place was paying a Portuguese friend of mine in Portugal with Bitcoin in 2015. It was instant, 10-minute settlement, but incredibly cumbersome. And we're all very crypto native, so we're used to navigating terrible user experiences. But if we want to get a ton more people on chain without them realizing that they even are on chain, then I think it really comes down to that incremental user experience improvement.
Yeah, I think, Charco is a chain abstraction maxi, I guess. That's what the bio was saying. I agree with that. I think there's been a lot of improvement in UI, UX, but we can do better. The reason why I got into crypto, I grew up in Turkey. Turkish lira just deflated like tons over the last 10 years. And one of the best ways to hold your asset, hold your wealth is through Bitcoin and other assets. So there's a lot of like different ways that people started to use crypto. The UX in Turkey is actually going to some of these like merchants in the streets. You can buy them like Bitcoin and other assets through them, right? So it's another different way to think about UI UX, which is not like something on your phone in the United States with Venmo and others, but more of like I'm gonna go to a merchant, I'm gonna buy Bitcoin, and then I can hold my asset. So that's the interesting side. And I think we talked about this before, is like on-ramps, off-ramps are a bit of a problem. So people need to make that experience a bit better. It's still kind of hard to get it on chain. Like if you ask your friends to come in and use some of the apps, it's pretty hard. So making that experience pretty easy. And in a way, like merchants that sit on the streets are kind of on-ramps and off-ramps too. So improving those experiences in the long term, I think is going to help us.
So biggest asset holders are institutions, and if we want to bring institutions on chain, we need to solve the biggest pain they have, and biggest pain they have is cross-border payments, which is like a 10 trillion market, and having like they need to use third-party custody when they need to trade between each other, which is also like a $10 trillion market. And I think blockchain solve both of it by sort of automatizing their workflow. And this is like very expenses, like millions and millions in lawyers to get this running. And we have this running for almost free. So yeah, it's like passing from mails to, from paper to mails.
Cool. I agree with what everyone pretty much said, which is it's largely a UX problem. I think it's helpful to think about it in terms of where crypto has PMF and where it doesn't, to think through kind of how we get there. So where crypto has PMF is definitely cross-border stablecoin payments. That has been extremely expensive and extremely difficult in traditional finance. So being able to send an asset like USDC to someone across the world for relatively cheap was a really easy use case for stablecoins to get a bunch of adoption. The second piece where crypto has PMF is using stablecoins in things like DeFi. So posting USDC as collateral to trade on Hyperliquid or in lending markets. Where crypto doesn't have PMF yet is in places like domestic payments, specifically in the US. Like right now, ACH kind of works for small payments. Wires are expensive, but if you're moving big amounts of money, the bank will waive the fee and it'll settle within a day. Like crypto can settle a lot faster, but if I use crypto payment rails and I pay someone in USDC today, if I want to off-ramp that into my bank account because I need to make payroll to my employees, then I still have to go through a wire or through an ACH payment to get that money into banks. So I think the real Schelling point for getting from 1% kind of stablecoin USDC adoption to like 100% is actually banks accepting crypto natively for deposits. I think that's really hard to get there. Like stablecoins are a massively profitable business. I think everyone has seen how much money Tether mints on the float of just issuing USDT on chain and capturing all the treasury yield. So banks are going to want their own stablecoin. So getting them to adopt something that exists already is quite difficult. But I think it's only a matter of time, given the demands for transparency and kind of instant finality from consumers.
I think someone mentioned institutions. I think it was you, Altan. How much of adoption is really dependent on large amounts of capital coming on chain from institutions, and particularly in the form of issuing assets on chain? When do we see hedge funds, mutual funds, money market funds, and large financial institutions issuing their assets natively on chain? And maybe going even further, when do we see nation states issuing bonds directly on chain, just cutting out the middleman entirely and having native on-chain assets? That feels like the end game that we should be aiming for, is institutions also using this infrastructure in order to, like I said earlier, right, move the world's assets from TradFi rails onto crypto rails natively.
I can go first. I think the question is really like, when is it interesting for institutions to come on chain in a material way? So right now, like asset issuers, specifically like, let's say like US funds or US commercial real estate, it actually doesn't make sense to tokenize this and put this on chain today. Like it used to be a regulatory problem, but now it's like, who's gonna buy it on chain? All the liquidity, like the Fidelities, the BlackRocks of the world, get access to these deals through kind of Wall Street. So putting these assets on chain, unless it brings a marginal buyer, doesn't really benefit anyone. So the real answer is you probably need more retail on chain to be the marginal buyer of these assets for institutions to feel incentivized to bring these assets on chain. And then on the flip side of that, institutions will come on chain and do DeFi kind of native stuff when there's sufficient opportunity for institutions to make material P&L that moves the needle for them. So right now, like, you don't see a lot of the biggest hedge funds in the world trading the assets that are on chain because their opportunity set is not big enough to justify them setting up the infrastructure and pieces like that. When there's more retail volume on chain, I think institutions can make the case for investing in the infrastructure and come on chain in a material way.
My first job was at Fidelity, and I saw firsthand how inefficient those rails are, transferring an account from one brokerage firm to another, or even like settling T+2 for an equities trade. I think that the entity that will get disrupted first will be the transfer agent. It's a very inefficient, it's a huge inefficiency. Like that is just sucking value out of the system. It's slow, it's annoying, and like a decentralized ledger perfectly solves that. My question becomes, why would they issue those assets on Ethereum? If you're BlackRock, why pick any open chain? So are these people just going to have their own centralized chains and transfer assets between banks? Because it's actually a huge incremental improvement to have instant finality. If you're a huge bank with a massive overnight repo debt obligation, I mean, every second you're counting the interest you accrue like on a second by second basis. So it's really important to have that like constant accrual. It's an incremental improvement that they'll want.
Institutions and nation states, right? A lot of people talk about institutions. Nation states are harder, I think. Just from my experience dealing with HMRC in the UK or others, they don't even have the infra to do data analysis on your taxes. Like, I don't see them do any asset issuance in the future. But I think the way it will go is like institutions will start adapting, and eventually there's so much incentive for the governments to learn about this and figure out how to tax these institutions, then figure out like, oh, there's actually a great opportunity for me to do a synthetic like Turkish lira, whatever, and mint it out there. But currently those are done by exchanges in Turkey, which is a very they're minting pretty much money from the volatility, which is bilira. So I see the way you're going is like institutions coming in, eventually governments figuring out how to do it. And that's the kind of the cadence that I think will happen.
We're talking about institutions coming on blockchain, but 50% of the world GDP is coming from countries who don't have financial market infrastructure. And this, we solve them problems where they need to delegate currently to London or US or Singapore, and blockchain actually make it cheaper for them. And they collectively have a loss of 100 billions per year per day in GDP, not having their financial infrastructure. And I think they can be big adopters. Second big adopters could be hedge fund investors, where hedge funds are, when you invest in a hedge fund, the hedge fund managers need to follow certain rules about how you will manage your funds, and there is like massive loss of hedge fund managers who doesn't follow these rules, and having all product tradable on chain can enforce these rules and make it very riskless for investors of these funds. And if you lower the risk, you get more investors out of it.
Yeah, those great insights. I'd like to also maybe touch on this idea that a lot of crypto gets transacted through centralized exchanges, centralized entities, and ETFs are also a centralizing force. To what extent are these kind of stepping stones into like a future where things are more decentralized? In the future, like, will ETFs matter if institutions and individuals and businesses are holding crypto, have better ways to hold crypto on their own? And how do you see this in the short term, medium term, and maybe medium term and long term?
I think one of the beauties of holding Bitcoin is that there's like no decay. You can self-custody it, and it's going to be worth one Bitcoin. If you have one Bitcoin on a ledger, it's going to be worth one. An ETF slowly bleeds fees over time, so you've got some decay factor there. But it's impossible for a lot of these institutions and entities to just self-custody Bitcoin. It's not as simple as writing down the seed phrase and putting it in 3 safes around America. they have a lot more problems, and we need to just make it easy for them in the short term, I think. And it's a stepping stone.
It's a spectrum, right? If you think about cross-chain, also infrastructure too, there's a lot of centralization. First time I started buying and selling tokens, I used Binance as a bridge. Like, it was very easy. You just go there, you swap the token, you go to another one. We replicated that a little bit with Intents too, right? There's a couple of routes you can go, which is like one solver, so you're trusting one solver to do the work. I've personally experienced sometimes using Intents, like the liquidity just didn't come for, you waited for liquidity to come in. So there is a spectrum. I think centralization still is like very useful for getting people on chain, and then eventually when you start learning into technology, then you start trusting yourself with self-custody, and then you go decentralized with the way. So I think it's a good way to start, but as you get more advanced, you start to use more decentralized solutions. But at the beginning, I don't see my grandma using, or my mom using even, grandma is a bit older, my mom using the decentralized wallet or decentralized MPC.
Yeah, so I think like things like ETFs are definitely a temporary holdover solution. There's a lot of funds in TradFi that can't hold Bitcoin because they don't know how to custody it, or they have certain requirements by regulators on what types of assets they can hold. So the ETF is like a great regulatory vehicle for them to hold crypto exposure. But eventually we'd like to see the world move on-chain completely and in a system that's fully decentralized. If I look at kind of on-chain infrastructure, like some of the others I mentioned, there's a lot of centralized components. And I think the reason for that is because it is easier and users don't care. So if I put on my personal, like, what I care about in crypto hat, I personally value decentralization extremely highly. I will think about whether I use an application or not based on if their infrastructure is fully decentralized. If you look at the biggest applications in crypto today, a lot of them are extremely centralized and users don't seem to care. So if I put on my founder hat, the question is really, when do users care about decentralization as a decision point on whether they use an application? And that's the point where infrastructure will become more decentralized because you as a founder or builder get paid to build decentralized tech. So I think the arc is hopefully more users care about decentralization. I think it's the job of those in the industry to kind of evangelize decentralization and kind of preach why it matters, why you should self-custody, why you shouldn't have to trust institutions or governments when you don't have to, because cryptography lets you do interesting things. But until users demand it, I think we will continue to have significant portions of the decentralized financial system be fairly centralized.
Yeah, that would be unfortunate. You want to add something?
Yeah, if we look at the example of Morpho, they did something very clever where instead of having institutions from the bottom up, they have institutions participating in their management. Users trust a lot institutions, and it's a very good way to get marketing. And if we can imply institutions in the management of our product, user will attach this trust to our product themselves, and this plays a natural bridge to like a more decentralized finance.
Yeah, we talked about a lot of decentralization, but one of the things that I was talking with the founder of Aleo, we don't talk about privacy enough. Like, if institutions are coming, they don't want to let everybody know that they've transferred $10 million to another party. So I'm excited about privacy solutions that we've somehow with layer 2s we did quite well, like with ZK and other technologies that we've created. You can go all the way through FHE, whatever. But I'm excited about that. I think those technologies can help us, and the scalability of those technologies also improved drastically over time.
I think privacy is so important, and it's so underrated, because I think people don't realize that the foundations of like capitalism is founded on this idea of arbitrage and information arbitrage. And if all of information is just openly available for anyone to see what people's business dealings are and whether the companies are, who they're interacting with, what money flows are happening, that there's little incentive for institutions and companies to like start using crypto rails until we have like real privacy solutions. Unfortunately, there's also like a counter push to that, which is the regulatory pressures to at least what we've seen in Europe is to make those technologies illegal or very difficult to use practically. So yeah, there's sort of a right balance to strike there. But I'm confident that maybe ZK is one of the solutions that allows us to get to that point. Maybe one final question here. Thinking about what's to come and sort of the innovation that you guys are expecting and excited about in the future. If we look at the last, say, year or two, we've seen a lot of recycled ideas or like slightly tweaked ideas just being like redeployed on new L1s or L2s, and not a whole lot of net new innovation. What do you guys think about that? And as a just general observation on the space, and are there any particular things that you would love for people to be building, like new primitives that you'd love to see being built or that you thought would be really useful for the industry moving forward?
Builders.
Yeah, I guess like this question, it's kept me up at night a lot because as a chain, you need the primitives. So yes, like it's kind of lame just to fork Aave and Uni, but your chain needs them. However, I do think there is a lot of innovation at the user experience level. I think that you can make transacting on chain much cleaner, give people more access to yield farming strategies with less clicks, and put it in a mobile app. And abstract away the entire concept of a chain and gas and custodying your seed phrase. So I'd love to see a world where the app becomes the most interesting thing, the asset that you're buying. You don't think about the chain that it's on. And then it'll be a game for these chains of how do I get the smart contracts that are sucking up liquidity to live on my chain? How do I get the assets that are being issued to live on my chain? Because there won't be these like rails of, oh, it's difficult for me to leave ETH to go to Solana. It'll just be, if you think it, you want to do it, it's a click away, and then your liquidity is on whatever other chain. So yeah, it's gonna be a app builders market going forward, I think.
Yeah, excited about this one. There's a lot of L1s, and if you look at L1s, L2s, L3s, they used to be a thing. So when you look at the successful projects of the cycle, Hyperliquid started as an app, turned out to be a platform later because they got liquidity, they got the users. Now you can just invite people to build on. I think Ethena is doing something similar here with this one as well. You start with the stablecoins and now turning into a blockchain to let others come in and build on that chain. So I think that's more exciting to me. I think we've built a lot of interesting things this cycle that a lot of people don't mention. Like last cycle when you go layer 0 just fundraised, wormhole is becoming a thing. So message passing is just solved. I think Interop is pretty much solved. Now it's a point to, there's intents, Ethereum community has been working on them very aggressively over the last year. I think we're at a point where we can start to almost like Legos and puzzles and kind of combine these pieces regarding on what you're looking for, what experience you want to give to the user, and give really good experience to the users to earn, to trade. I had a talk in Denver. I talked about Universal X, near intents, these technologies that allow you to go 1-2 second finality to other chains, which is exciting. That part is done. I think trading has improved a lot, and that's kind of the first V1 of chain abstraction. I think V2 is kind of taking everything, being able to do cross-chain lending, cross-chain DeFi, getting a bunch of assets from here, anywhere. Like if you look at top 20 assets, apart from Ethereum, all of these assets are not like utilized. Ethereum is around, we say this like asset utilization rate, which is 16%. But if you look at Bitcoin, if you look at XRP, all these assets, they're pretty much doing nothing, right? So that's the exciting part for us, and that's the future that we're building as well.
Very excited about privacy. Institution won't come if there is no privacy. And there is like Noir with ZK, Zama with FHE that are coming like pretty soon. Their audits are like maybe Q2, Q3. And this will allow a ton of stuff. With Symmio, we've built on-chain derivatives as MVP with it, and we think that can do that a lot. Also excited a lot about ER protocols that are building like loops with Tina, Morpho, and bundle combinations. And we've seen some other protocols that can build on top of these combinations. And I think that it's impossible in TradFi, and we start to see like very cool stuff to aggregate all the risk and finding very great liquidity. Yeah.
Thanks. To Alton's point, I think there has been a lot of innovation in the infrastructure for this cycle. So I agree with his point that like Interop protocols have improved pretty materially. Why it's hard for net new things to happen in DeFi is partially because building new things is hard. Like it's hard to come up with a new design that's interesting for people. It's hard to build code from scratch. It's easy to fork Aave. The other thing is in 2021 we saw a lot of really crazy innovation in DeFi, and I think a lot of investors, retail users got burned because a lot of these products were like ill-conceived. My view is like at least we were trying cool shit at that time, but like that is a material headwind to innovation. If you're a founder or VC, as a founder, you can take the risk of designing something new and figuring out if there's going to be PMF, or you can look at something like Aave and be like, well, it's clear that people want a lending protocol, so like maybe there's this new chain that I can launch it on and find some unique distribution. And as a VC, you're looking at the set of projects that you can invest in, and you see, okay, a lending protocol on a new chain, like we know a lending protocol will be used on that chain, so like that's an easy bet to get around. But this net new product, we don't know if anyone wants that, so it's a much harder bet to take. So on both the founder side and the investor side, there are incentives to copy something that is net new. I think it's very logical. It's a little bit sad. I think the next wave of innovation in DeFi will be at the composable asset level, and that's what I'm building. I think things in the privacy space are really exciting. It's very clear that large institutions are going to demand privacy. So having things like Ts or ZK coprocessors that let institutions do things off-chain and maybe not in OTC order books, but on some verifiable system on-chain is pretty interesting. But I think the way we get there is just founders sucking it up and building cool stuff. So I guess that's what I'm doing.
All right, well, build cool shit. Go do it. Thanks, guys. Yeah, so we'll break for lunch now, and we'll be back here around 1:30.
How's it going?